All right. Looks like we're live. Testing, testing. Audio looks good. Connection looks good. All right. Welcome everybody to Midas Investing Live. We've been a couple weeks. Hopefully we're going to be able to keep to a good schedule this year. So far, so good. Only 2 weeks since our last show. So, all right. Lots of stuff to talk about today. See how long we go for today. Probably also depend on how many viewers show up today or not, but we'll see. Okay, make sure we got everything in order here. So it's been a pretty good couple weeks in the market, especially for my portfolio. The S&P itself is doing pretty good. I think it's up a little under 1% or something like that, if I remember. Yeah, like 0.9% so far in the year. So we're off to a decent start for the market as a whole. And my portfolio is already doing pretty good as well, beating the market on that, but it's only 2 weeks, obviously, so it doesn't really mean too much. And it's also worth noting that the Russell itself is doing quite good so far. So that's a big reason why. I'm not beating the Russell, so I'm somewhere between the S&P and the Russell is what I'll say on that. It's about 4%. So kind of midway between that. And so the Russell itself is probably a big aspect as to why we're doing so good so far. But it'll be interesting to see if the Russell can keep it going. If this is going to be a good year for them. And I think there's some signs that could be the case, but there's also some signs or some things that could definitely interrupt that through the year. So it's definitely one of those things where that's where the sentiment and the excitement is as of this moment. But fundamentals and things will have to follow through to a certain degree in order to achieve that. It's been a while since I checked, so I can't remember. I don't know where it is exactly right now, but I know at least like a couple months ago, the expected EPS growth for the Russell was a very, very high double digits for this year. But that's partially due to poor earnings performance over the last couple years in Russell. So it's coming off of a smaller base is kind of the point. And so that would be good, like I said, if it does follow through. But we shall see on that. Like I think I heard a number like 50% earnings growth a few months ago. So I don't know if that's still where the analyst expectations for the Russell is now. It may have come down since then or not. But even if it's like 20% or 30%, that would still be very, very good. Whereas the S&P, also can't remember exactly what the earnings growth is supposed to be off the top of my head right now, but it's at least kind of in double digits. It's like at least 11, 12% or something like that, but it might be like 15, 16% or something like that. We did have good earnings growth last year. I think a lot of the sentiment around the market last year, a lot of people were talking so much about AI and stuff like that throughout the year that you could be mistaken for having thought that this was entirely a multiple expansion market, right? That it was largely just people buying up the earnings rather than the earnings itself, but that's actually not the case. I again can't remember the exact numbers off the top of my head, but I've heard many people break it down as far as like earnings growth versus dividends versus price appreciation for the year, and earnings growth actually was the largest component of the S&P returns last year if you break it down by those categories. With obviously a huge factor to that strong earnings growth being the concentration into the larger Mag 7 companies where there is large earnings growth in NVIDIA and such. So we shall see if that's the same for this year with the S&P, whether maybe it's a multiple year or an earnings year or what have you. And then, like I said, well, the Russell, I think it's kind of already floating on decent multiple because of the expectations of the earnings. So we'll have to see on that front. But anyway, looking at our portfolio, nothing too dramatic change in the core long-term positions. I did sell out of Mastercraft this week, not because I think it's some super richly valued stock or anything like that, but It has come back up decently over time, and frankly, I had definitely become a little bit disillusioned with that position, and some of the expectations I'd put forward in my original video definitely didn't seem to come true. They had spun off a division which had kind of changed up the overall fundamentals significantly, and so essentially I was kind of just looking for an option, a time frame to get out of that one. I think it was up like I was up like 20%, I think, on my position overall, like 15 to 20%. So, you know, we at least got some returns on that, but definitely wasn't exactly what we had hoped for. And it was a smaller position, and I'm just less enthused with that particular section of the market and the theme. But I will say that that's not to say that it's not going to do well. In fact, some of the details we'll talk about in regards to sector rotation could portend that maybe that'll continue to do well, potentially. But like I said, that's not for me to be concerned about. I decided I'd rather focus my money on other areas, essentially. So that's where that's at. I think as far as like the actual core long-term positions, that's really the only change that happened in the last 2 weeks. I don't think I didn't trim any of the minors. And so we're still kind of just riding on that. But we have shifted around our ETF strategy pretty regularly, as we do. That's just the nature of that particular strategy. It's on a weekly time frame where we adjust which ETFs we think we're going to go into based off of momentum factors relative to the S&P 500 and what we think is likely to outperform. And we're kind of moving that money around. It's a strategy I developed about a year ago at this point, which, you know, is very different from long-term value. I understand, but nonetheless, I am allocating a pretty decent chunk of my portfolio to it. And in a sense, this is, as I've kind of talked about before, I expect the strategy to be able to outperform in its own right, but essentially it's also being used as an alternative for holding cash relative to my previous desires to hold large amounts of cash in past years. So you can see like I'm holding only about 1% of cash, and really the goal is actually to have basically 0% cash and just kind of have it in this rotational strategy that is designed to prevent large losses in market downturns and potentially still outperform on the upside, which, you know, we'll see how that goes over the coming years. It did quite well last year. I was very happy with how this strategy worked out last year in general, and the back tests look pretty phenomenal as well, generally speaking. But, you know, backtest and in the real world with real money is different things. So again, 1 year in, we'll see how it continues to go. But I did want to at least kind of talk a little bit about that, and I figured I will probably more regularly point out which particular sections of the market that it's pointing to from time to time. But like I said, it shifts around on kind of a weekly basis. So it's one of those things where if I say, oh, I'm long the large cap communications ETF this week, you know, like that's not necessarily super helpful information for you guys per se, because who knows, maybe the week after that it'll decide that was kind of a false signal and get out. It can change on a weekly basis, but sometimes it stays in these ETFs for several months at a time, and that's really actually the goal of the strategy. The goal is not to make good returns in 1 week. You know, it's not really my approach to anything. The goal is to be willing to experiment on a weekly basis with, is this position breaking out? Is this position breaking out? Is this position breaking out? And the goal is to actually find one that will sustain that trend for ideally, yeah, several months at a time. Who knows, even years at a time. Some of the back tests on a few of them shows for very long times. It just depends on whether or not money is in fact constantly rotating into that area or not. VGT, the tech ETF, the Vanguard tech ETF, I would say is a perfect example of that. This one's been here. It's 4% of my portfolio right now, and it's been a position in this rotational strategy since August, I believe. And so, you know, there you go. That's 4 to 5 months that it was going in there. And it, like I said, it was since August, but I think it was only out for about a month prior to that too. And then it was still on for most of like a year prior to that. Obviously, because tech's been doing great for many, many years. So like if you look at the backtest of VGT for the last 5 years or so, you're more likely to be long VGT in this strategy than you're likely to not be for the past 5 years, right? And that's not the case for necessarily the other ones, because it all depends on what the market is or is not doing. But I bring that up because, like I said, I did kind of want to maybe go over a few, at least from time to time. I'll kind of like discuss which ones it's in, because part of the another useful aspect of this strategy is obviously, like I said, I expect the strategy itself to do well in its own right, but it could give you a hint as to where to maybe go looking for actual long-term value positions as well. If it looks like a sector is starting to break out when it has been kind of in the doldrums for a long period of time, well, then maybe, maybe you missed the bottom if it means if it's now already starting to break out. But nonetheless, when things start to break out of kind of a large basin, they often keep going for a long time. And that doesn't mean that the components within that sector don't have decent value to them, right? So like if you see a signal break out on small cap materials and a couple weeks in it's still in there, well then maybe it's worth it to go looking at some small cap material stocks. So that's kind of the idea to it. So there's not only, like I said, I expect this to do well in its own right as a strategy, but I do think it's kind of an interesting way to potentially even look for opportunities in longer term value as well. So on that front, I did want to note that it shows VGT here is 4% of my portfolio, but actually this is what my portfolio is as of Friday, and it doesn't say what the strategy is going to allocate into as of Monday, because like I said, it does it on a weekly basis. And so I actually already put the orders in. I am selling my VGT when the market opens on Monday, and it'll be rotated into something else. So that's part of the reason I knew off the top of my head that it had been in since August, because I was kind of curious. I went and looked and I was like, wow, we've been in VGT for a while, because the strategy's just kind of been riding that. So I was like, wow, when would it happen? And since August. So we are getting out of VGT and going into some other ones. And as you can see here, I'm already in Vox and VHT, which is the communications, Vanguard Communications ETF and the Vanguard Healthcare ETF, which both have also been pretty common to be in this strategy for the last year or so, though less consistently, I would say, than VGT, but nonetheless, they've definitely been doing reasonably well. And then PSCM is small cap materials, PSCT is small cap technology, and then actually I have the, because like I said, I could be selling out the other ones here. So the ones I'm actually going to be long going into Monday, I have listed here is Vox. Vox is going to stay. So large cap communications, large cap healthcare is staying. But I'm also going to be buying into large cap industrials on Monday, large cap materials on Monday. And then, like I said, I'm selling out of the tech. We are keeping in small cap materials and keeping in small cap tech. And so, with all those there, that's 4 out of 11 of the large cap ETFs and 2 out of 9 of the small cap ETFs, which isn't a crazy amount, but I did kind of want to point out, and that's one of the reasons I'm actually bringing this up today, is because that is the most amount of these sectors that this strategy has pinpointed on a specific week within the industrial sector groupings of the ETFs, because I also do foreign ETFs as well, but we'll get to that. Since I started doing it, and that's kind of at the same time that I've definitely seen around the financial social media and financial press over the last week or two about how much it appears that there's good rotation going on in the market. So that was definitely one of the topics I kind of wanted to bring up, was that, I can see it within my own sector rotational ETF strategy that I built, that it does appear like there's some good rotation going on. And that kind of goes right back to what I was saying about the Russell being up decently since the start of the year. It's starting to really break out, and that itself would be rotational. So it appears that money is starting to shift around. And I don't have a good ETF for just the Mag 7 as well, but I've seen people showing charts of the Mag 7, and it does appear that the Mag 7 has been somewhat faltering a little bit. Obviously, certain components of that more so than others. And then I've seen people do ratio charts of the Mag 7 versus the non-Mag 7 S&P 500, and it does appear as though that itself is also starting to break down. So maybe the Mag 7 will continue to do fine for the year, or maybe it'll be even flattish on the year. That doesn't necessarily mean that they're doing bad per se. It just means that it does appear as though money is starting to rotate around. And then, like I said, though, that is only really good as long as the fundamentals continue to back it up. So we'll we'll see if that's the case, because if the fundamentals don't really back that up, well, then the money will probably just shift right back. It'll probably do that. So we'll see what happens with it, but it does maybe appear as though we're getting some serious broadening out in terms of the participation of different parts of the market, which would be good, especially for those of us that are allocated to smaller companies in other parts of the economy than technology. So we'll see what happens with that. Very, very curious to see how that goes going forward. So yeah, like I said, that's I listed the large cap and the small cap ETFs that the strategy is going in. But I also do have foreign ETFs as well in the strategy. So not all of these are going to be continued in. So like the last couple weeks has been pretty good for the foreign ETFs in terms of which ones the strategy is pointing out. Though which ones actually did well is a whole different question, because like I said, the point of this strategy is not necessarily to have every single position do well. The idea is to be willing to potentially lose a small amount of money on one or two of these ETFs to find the one that's actually going to go off for a nice multi-month run or something, and be able to hop into that. So one I did kind of want to call out is the South Korea ETF, which it put me in a few weeks ago, and that's like a perfect good example where I hopped into this just based off the strategy, and it very, very quickly gave like a 20% return in no time. Wouldn't have known that was going to be the one. Don't know anything about the internal fundamentals of the South Korea market at all. Like I said, it's entirely based on price, the way that the strategy actually works, price and relative price to other markets. But something cool is going on in South Korea, and I do believe South Korea is a pretty concentrated market themselves, so it's probably very much tied to specific companies. Also, like actual gapping up on the weekly candles there, so kind of interesting. But yeah, so kind of interesting. But the ones that it's going to have me still be long in terms of foreign markets going into next week is going to be Canada, Switzerland, and we're still going to be in South Korea. So we do also have the UK and the EU here, but those two I'm selling out of immediately on Monday. But anyway, outside of that, also the rotational strategy is rotating pretty heavily into gold next week as well. It does have its kind of base allocation, which this is closer to its base allocation, but it's gonna up the size. In fact, it's probably a lot of the VGT money. The VGT money is probably going to gold, basically, which gold itself has started to break out a little bit of the kind of range here at 4,500 that it had been for about a month or so, which is not a very long period of time. Gold can't seem to go down. It can't seem to go down at all. Neither can silver. They had a little period there where there was a little bit more volatility for both of them, where they were, or at least silver was going up like 5% one day, and then it'd be down 5%, it'd be up 10%, it'd be down 10%. It was literally doing that like every single day for like 3 weeks there. Not that it's still kind of doing that. Obviously on Friday it was up almost 5%, but and then gold, obviously on a comparable basis, if silver's up 5, gold's probably up like 1.5. That's kind of a pretty typical kind of scale in terms of the volatility, but yeah, kind of interesting. So also we began earnings season, or actually no, before we start talking about earnings season, let's also talk a little bit about FG. Obviously, it's our favorite company. We like to talk about it all the time. And last time we had a show, I was talking about the distribution to FNF shareholders that was made by FNF of a significant portion of their ownership of FG, and we had already gone through a week or two of pretty ugly downward movement related to that, and I was making the case based off of differences in the shareholder base between FNF and FG. We had already gone through this particular large candle of volume, which was like 7.5 million shares or something like that. And I had said that based off of the differences in the shareholder base that I had analyzed, that I could easily see there potentially being about an equal amount of shares at least to kind of get us up there. And it turns out the next week we did have almost exactly the same amount of volume. So not to toot my own horn, but I kind of called that almost perfectly. Now, I did say that that was sort of like what I would see as like a likely needed amount to kind of clear the likely sellers, but that wasn't necessarily a maximal amount either. I even said that it could theoretically be twice as much of that, which means that you would theoretically have like 4 of these weekly candles equally sized. So the next week that we followed up with, we did get another large candle. What is this, like 4 million? But not quite the same size. So I do think that's sort of a good sign that it's maybe started to slow down. In terms of the price action, you can see it was another week down of similar size to the week prior to that, and the week prior to that, which was the second week I was talking about, actually wasn't as bad in price as it was for that first really bad week due to the high volume. Obviously, we had an even worse week a few weeks prior to that, but that was when they had officially announced the final ratio of the distribution. And then also at the same time, there is more than one thing happening in the world. So obviously it's not necessarily that's only because of the distribution. There is other things happening. There is still the kind of the larger private credit discussion that people have been talking about for a long time. And I was talking about months ago when it was kind of first starting to become a thing, and people were worried about some of the quality of that. And it is true that FG does have exposure to private credit assets. And so I do think they're kind of being thrown in the dumpster with a lot of the companies that people are concerned about that. I do think that the broad market believes FG has more exposure to private credit than I think they do, because I kind of look at it as I know I've done this analysis on a live stream before. I went through their balance sheet and looked at their investments, and from my perspective, it's like 15 to 20% of their portfolio that I would argue is basically private credit. So that's very significant, but it's not like 100% of their balance sheet. And it almost seems to me like the market thinks that basically 100% of their balance sheet is private credit, and 85% of their balance sheet or of their portfolio is allocated by Blackstone, which is a firm that does private credit. But that doesn't mean everything that they have from Blackstone is private credit, because not everything that Blackstone does is private credit. So I do think there's sort of some confusion in that regard a little bit. But point is, I've been kind of pointing out to this is the Blackstone secured lending fund, which in my opinion is a decent proxy for the similar types of assets. And you can see the correlation. It's quite strong. And so obviously, yes, well, I was pointing to this downward slide right here, and we're mostly talking about the dividend distribution to F&F. It's hard not to also notice that at the same time, the Blackstone secured fund was also coming down pretty significantly. So it's a little bit of both. It's not just the dividend distribution. It is also the private credit concerns is what I would say on that front. And then also another thing on the volume I would point out as well is that as you can see that with the spike up in the large volume days, as it's gone on, we're trending down. We're trending back down towards the longer term average of the volume. However, they did increase the float, right? They almost doubled the float with this distribution. So what you would expect is actually that the volume levels themselves would basically almost double. So if I would say, because like this is sort of when they announced the distribution. So like this is sort of the average that it was at before that whole thing became part of the discussion. And so I would say like this is kind of like maybe a baseline level for that. And it's showing us over here I have the 90-day moving average for that, which is like 400,000, but that's 400,000 as of today. So if I kind of like zoom back to the beginning of that discussion, and it says 175,000 shares is kind of the 90-day moving average going into that. And so if you kind of assume that it's going to be double that, then that would be like 350,000 shares a day. And the moving average is currently at around 400, and the last day that we had was 700 to 800K, 778,000. So, we would theoretically need to get down to kind of like about half the volume we're currently at to theoretically get us to a float adjusted pre-dividend distribution moving average of the volume. And then at that point, you could say, okay, it looks like the market has fully digested this. But that again assumes that that's going to be the same, and it assumes that because we doubled the float, there would be a double of volume. There's not necessarily a perfect logic to that. You could theoretically have a doubling of of the uh, the float, but also end up with a tripling of the volume. Like it doesn't have to be one for one. This is my point. So theoretically, we could already be at the basin level, but we'll see. We'll see how things go moving forward. Another thing I'd point out is that we are starting to get a little bit more of those green candles with the high volume days too. As it's gone on, it's become a little bit more greenish as we've come along. Obviously, on the week, it's still red. So that's what we'll be looking for, is can we get ourselves a nice green week? That would be nice. And then obviously we have earnings coming up as well. So really, I'm not expecting the stock to do much of anything positive until earnings, and then really we just have to hope that it's a good earnings. You know, I'm hopeful for that. Also, I can't remember if it had already happened or if I had even talked about it in the last show, but Chris Blunt, our CEO, our Lord and Savior, did go and buy another, I think it was another 5K shares, nothing too crazy. I think it was after this week, or it was near the end of this week, I believe. So, you know, he's still out there doing his open market purchases, trying to show solidarity. It's like I said, 5,000 shares, and he owns like 1.1 million at this point. So it's not like it was a huge jump up in his allocation or anything. But the point is, it's still more open market purchases when he otherwise doesn't have to, and in fact is granted free shares every single year due to his compensation package. So it's, you know, not like he necessarily needs to buy more in order to actually acquire more of the company. But again, I think he's quite explicitly showing solidarity. I think that's actually, if I had to guess, I'm willing to bet that that's probably exactly what he's doing. It's like just him being like, yeah, we're good. But again, we'll see what comes with earnings on that. We haven't gotten the LIMRA reports yet for Q4, which are the reports that show the overall annuity market numbers. We haven't gotten those yet, so I am trying to keep an eye out for those as well. But we'll see. Okay, so let's. Like I said, earnings. That was the other thing I kind of want to talk about. Let's talk about that. Specifically, we're going to talk a bit about JP Morgan's earnings. We really only had, you know, the major banks do a lot of their reporting first, and then so we're really going to get the majority of earnings here over the next several weeks. But I do like to go over some of the financials earnings as they come out, and JP Morgan is generally one of my favorite ones to go through. One, because they're one of the largest banks in the world and therefore have a very large impact on the US economy and are a good window into the US economy as it's coming through. And then also just because I'm a big fan of Jamie Dimon, so I do like to hear his commentary on things as well. But anyway, going through here, don't really want to talk too much about the specific numbers. So like I said, we're mostly just going to focus on what I would say is kind of like one of the key things you can look at, say, is sort of the market itself and the economy starting to deteriorate, or are we still in like a relatively good fundamental position? And specifically what that is looking at kind of like the charge-offs, the credit costs. They make loans. That's basically the majority of their business, is they make loans and then people pay back those loans. Whenever you make a loan as a bank, you also make an estimate of what you think a probability weighted expected potential loss on those loans is, and then you charge that against your balance sheet as what they call an allowance for loss reserves. And then as the loans perform, you then adjust those numbers based off of further expectations, but also on the actual results. So if loans come in and they fully pay back, and you had already set aside a certain amount of allowance for that loan, you might release that allowance because, well, it turns out that they did pay back, even though you had said that there was a certain probability chance that maybe they weren't going to pay back. And then on the other end of that, you also have what they call charge-offs or net charge-offs, NCOs, which is them saying, oh, okay, well, actually, we did take a loss on this particular loan, so we're going to charge that against our loss reserves. And, you know, people worry about charge-offs, but the truth is that charge-offs are expected. Like I said, it's a probability weighted thing. That's why they build the reserves, because they know that they're going to have charge-offs. And really the goal is to make sure you always have more allowance set aside than you have actual charge-offs. And that's the job of risk management in a financial institution. So Within that, I'll point out that they had net charge-offs of 2.5 billion, which is up 150 million year over year. And their net reserve build of 2.1 billion. However, as I said here, reflecting a 2.2 billion reserve established for the forward purchase commitment of the Apple credit card portfolio. So Apple's credit card that they had done with Goldman Sachs, I can't remember the name of it right now, but they had been doing a consumer credit card with Apple, and Goldman Sachs has decided that, you know what, we don't really want to be in the credit card business anymore. So JP Morgan recently picked that up for a decent discount. I think they got like a 25% return just by marking it up to book, essentially, right off the bat, which is pretty nice. But obviously, like I said, that doesn't take into account whatever losses you'll have on that front. So they do have a big build on their reserves here. However, like they said, net more than the actual amount, because here the net reserve build is 2.1 billion, but they actually increased it by 2.2 billion, which is even a larger number just for that. So essentially, like I said, the charge-offs, it's fine as long as it's within the scope of the net reserve build. And yes, this number here is larger than this number, but they're not necessarily comparable. So that's not really an over relevant thing. In fact, I would focus more on the year over year level. So 150 million increase in net charge-offs on a year over year basis. But what you have to think about is that's 150 million relative to their balance sheet, which is in the trillions. So that's actually a very, very small amount. And so overall, what I would say is that their credit quality is fantastic. There's really no issues here at all. The only thing that makes it even potentially look bad is, like I said, the Apple credit card, and that's because they acquired it. So it's just a function of how the accounting works, really. But yeah, everything's looking very, very good in terms of their overall numbers. You can go down into the subsections here. Consumer and community banking, CCB, which is one of their major segments. This is kind of the main consumer, deposit banking, than what you think of as traditional form of banking. But this also includes that consumer portion of their business that also includes the consumer credit card. So here they talk basically that same details that we were basically just talking about here, but it's now focusing specifically on this. But within that, you can also take a look at the credit costs themselves here, net charge-offs, compared on a comparative basis. Yeah, still very, very good. And then also their commercial and investment banking, even better, which is where the actual loan making happens. So it's like there's a deposit side of the business as well as the consumer side of the business, and then the commercial investment banking, which is where the actual loans are being made. Everything's looking very good. Over ROE numbers looking very good. And they also have asset wealth management. So like I said, I'm not really going into the finer details there. I just kind of wanted to talk about the charge-offs and the allowance, because if you're going to look at JPM as a barometer for the economy, then really just those numbers alone, just looking at what's happening with their loss reserves and what their charge-offs, and then also I would say looking at what's happening with deposit growth and loan growth as well is useful. But those are more about like growth of the economy versus deterioration of the economy. So it's like if you're worried about deterioration of the economy, you look at the loan loss reserves, you look at the charge-offs, and if you're wondering how growth is going in the economy, you might want to look at the growth in the deposits and growth in the loan book. So yeah, and then also in their conversation here, the transcript from Jeremy Barnum, the CFO. A few points to highlight: consumers and small businesses remain resilient. Resilient being their favorite word in these transcripts, going back for like the last couple of years. We continue to monitor leading indicators of signs of stress, and despite weak consumer sentiment, trends in our data are largely consistent with historical norms, and we're not seeing deterioration. And I think that's worth noting because, yeah, there is just so much negative sentiment, both in many, I would say many investors' perceptions, but also just in like the consumer sentiment data. And I mean, that makes sense because investors are consumers at the end of the day. We're all consumers. And we're all investors in the same way that we are all labor, but we are also all capitalists here in America anyway. That's, people like to split the classes into different groups here in America, but at the end of the day, everybody's a little bit of both. The question is what percentage are you of one or the other? But that's how we are. It's like I'm a member of the labor class, but I am also a capitalist in that I own assets. That's just the nature of it. So I would say like people tend to, I would say, allow their sentiment in one aspect, one role of that feed over into their sentiment about other things. And then obviously there's the the media headlines doing their job to essentially try to scare people in various ways. So I've obviously been talking about this a lot in regards to labor indicators, because a lot of the labor indicators have been weak throughout the last year. But I do think that a lot of people are comparing those labor numbers against the previous 2 to 3 years, in particular 2024, 2023, and 2022, where we had very, very strong labor market that was like much stronger than average over the historical norms. And thus when you see that decline come down, it makes it look like labor's falling off a cliff, but really you're reverting to the mean. And that's the thing that is, I think, confusing a lot of people. And then even further beyond that, there's the second layer of things that I think has really thrown people for a loop when it comes to looking at a lot of the labor data over the last year, is that we also had a dramatic shift in our policy in regards to immigration. It's like we basically completely closed off the border, and then we also have done a lot of removals of immigrants from the country in various forms. And like I said, this is not a political show. We're not here to discuss the positives or the negatives or the beliefs about what is good or what is moral in any sense whatsoever. That's not what we're doing here. But it does have an effect on the labor numbers, because if you get used to seeing 200,000 jobs growth per month on average, which is what the kind of average was over like the last 10 years going into COVID, that's kind of your baseline. That becomes your assumption about what a healthy labor market looks like, is when we get between 100 and 300,000 jobs a month or something. That's a healthy labor market. And it's like, well, that's true, but if you're also getting like 75,000 to 150,000 of immigrants per month on average during that same period, well, then if you remove that number, you have to think about like, well, what would the typical normal be outside of that? And I think that if you do adjust the longer term averages for immigrant numbers, then you actually don't get last year looking that bad. Now, I say that's in terms of just the labor market itself. It's important to kind of isolate that. So that's why I would say that I'm not particularly worried about things like the unemployment rate and things like the labor force participation rate and the job growth numbers. But it doesn't say anything about the actual nominal GDP, because the truth is, again, this, regardless of whatever your politics is that immigrants do positively contribute to GDP growth, no matter what. Like, there's no ifs, ands, or buts about that. So there is an absolute decrease in terms of the economic activity due to the change in the labor policy, but that does not necessarily mean that you're going into a recessionary level, because the baselines have changed. And so that's basically been my base case as far as all the labor indicators for the last year. I know I've gone on about this pretty much every show almost, I feel like, for a long time. But I will probably keep doing that, because there's just still so many people out there that are repeating the headlines, the really, really poor understanding of how the economy works. It's like we may still go into recession, but it's not necessarily for the reasons or anything that people think. And I don't necessarily think that that's not my base case at all. Like I said, I think that overall the labor market is still relatively fine, and it appears that JP Morgan largely seems to agree with me, at least in the short term. So that's the comment, like I said, from the CFO. There was also, I think I was talking about 6 months or something. Yeah. There's also comments from Jamie Dimon himself, talking about kind of the general macro environment. He says, but I think when you're guessing what the macro environment is going to be, if you ask me in the short run, call it 6 and 9 months and even a year, it's pretty positive. Consumers have money. There's still jobs, even though it's weakened a little bit. There's a lot of stimulus coming from the one big beautiful bill. Deregulation is a plus in general, not just for banks, but banks will be able to redeploy capital. But the backdrop is also important, but the timetables are different. Geopolitics is an enormous amount of risk. I don't have to go through each part of that. It's just a big amount of risk that may or may not be determining the state of the economy. The deficits in the United States and the world are quite large. We don't know what that's going to bite. It will bite eventually, but because you can't just keep borrowing money endlessly. But so early on, fine. Who knows? Kind of a funny way of saying it. But it's worth noting that Jamie Dimon is pretty well known for giving giving some very cautionary kind of comments in these calls whenever asked about the macro environment. This is a very, very positive statement to make for Jamie Dimon. Like for him to give a 6-9, even a year, month out kind of forecast for the economy, not a specific forecast, but he at least gives a general sentiment that he thinks it's looking pretty good. I think there's something to be said there, because usually he's the guy that's likened to call out all the risks out there. He's top risk manager in the world, basically. But to talk about a couple of the specific things he says, I already talked about kind of the labor market specifically. But the truth is like he said, the consumers have money. I could show you various indicators on that. But he also talks about the stimulus coming through from the One Big Beautiful Bill. I do think that is something not to be discounted. He's absolutely right about this, is that a lot of the things that were put in the One Big Beautiful Bill that were going to be an economic stimulus were largely going to be delayed by about a year. And so here we are about a year later, that stuff's going to be starting to come through. One in particular being there's expectations that there's going to be relatively large tax returns due to a lot of the little changes in the tax laws, including the no tax on tips, no tax on overtime, and also they also upped the standard deduction. They also upped the SALT caps for the state tax deductions. There's a few other things, but the point is there's expected to be larger tax returns, and we're going to be going into tax season here over the next few months. And so that's going to be more money in consumers' pockets, which means that they're going to be able to pay down debts if that's what's stressing them, or go out and spend it into the economy if not. And so either way, that's quite a positive for the economy as a whole. That I'm gonna skip past the deregulation part, but then skip actually to where he's talking about the deficits, because it's worth noting that is going to be a bit of a negative back for the deficit. Now, I was actually quite impressed last year with how much the deficit actually improved, largely because of the tariff revenue. The tariff revenue was definitely the largest component reason as to why the deficit pulled back last year. But we went from like a 7% of GDP deficit into about a 5.5% of GDP deficit. It depends a little bit on what the Q4 GDP number is going to look like. So I'll give a final answer on that with Q4 GDP. But with a relatively conservative assumption on what's going to happen with Q4 GDP on a nominal level, you get about 5.5%. Again, relative to a 7% that we started with. So it's about a quarter of the deficit was fixed last year. And like 2/3 of that fixing was the tariff revenue. So with that in mind, there is basically a pretty much baked in expectation that we're probably not going to improve the deficit anymore this year. In fact, it's probably impossible to really improve the deficit anymore really at all, without like much more substantial changes to the spending, the non-discretionary spending. So not even the stuff that they argue about in the budget bill. Like that really has very little to do with the deficit. The deficit at the end of the day comes down to Social Security, Medicare, Medicaid, as well as the interest expense, and those are non-negotiable. They're written into the law, and or they're just interest expense that you have to pay. So there's really nothing you can do about that unless you dramatically shift the way those policies are written. Which is worth noting that when they were doing the One Big Beautiful Bill, obviously there was the Medicare and Medicaid cuts that everyone was screaming and hollering about, which and I say screaming and hollering because this is another thing that I think nobody seemed to really understand what the actual discussion was about. So a lot of people especially people who are on Medicare and Medicaid, and or they know people who are on Medicare and Medicaid, they get very emotional when that topic comes up, because they think that means that somebody they know and love is going to be thrown out on their ass or whatever. And that's not to say that there isn't going to be potential individual cases of that, because I do know that, for example, one of the things that they did do is they did go through and I know remove people from the roles of those programs based off of what they saw as them actually being ineligible. But then you'd have to say, it's like, well, were they ever eligible? I haven't gotten into the finer details of it. You can certainly find individuals who were hurt by the changes in the Medicare and Medicaid policy. That's not what I'm saying. I'm not saying that nobody was hurt. What I am saying is that on net, overall, they did not cut the spending of Medicare and Medicaid. That did not happen, even though that was in the headlines over and over and over and over and over again. Like literally last year, they spent more money on Medicare and Medicaid than they spent in 2024. Just like in 2024, they spent more money than they spent in 2023. Just like in 2023, they spent more money than they did in 2022. And by the way, in 2026, they're going to spend more money on Medicare and Medicaid than they spent in 2025. That they did not actually cut the number. The thing that they called cutting was they decreased the future growth rate of those programs. They said, okay, we've already baked in that we're going to increase the spending by whatever, I think it was like $1 trillion or something over the next 10 years. And then they decreased that to like 500 billion. But so it's still going to increase. It's still going to increase. It's just going to increase slower. And then that decrease in the expected growth of future Medicare and Medicaid was what all the headlines were calling cuts to Medicare and Medicaid. So if you'll excuse me, but that's literally like Orwellian language to call that cuts. Like it's literal bullshit. Like it's literal bullshit to call that cuts. But again, like I said, doesn't mean you can't find individuals that weren't affected by it. I just mean on net overall, no. Overall, they did not really change anything in Medicare and Medicaid. They just slowed the growth a little bit. And for the record, those are the fastest growing parts of the spending in our government. So they needed to slow down the growth of it. As far as I'm concerned, they need to slow it down more, actually. No, I wouldn't, like I said, I wouldn't necessarily do it in the ways they are. If my approach, by the way, if you were asking me how to fix the deficit, I would introduce means testing, meaning that like people who are relatively rich would actually be cut out of the program faster, because like, you know, if you're relatively rich, you can still collect your Social Security. But in my opinion, we need to change that system around. Like people think of Social Security as like a savings program. It needs to stop being thought of as a savings program, and it needs to be thought of as a tax and welfare program, because that's what it is. And so it's like, if we want to keep it and you don't want it to blow up our financial situation, that's what you need to do. Make it so that it's just an actual tax and welfare program, so that rich people therefore don't get to have the benefits, but they still get taxed for it. And then you could actually fix the program a little bit. And there's other things beyond that too. Like there's all sorts of other things you can do. But like the point is it's the actual structure of the program that needs to be fixed, not cutting around the edges of who's eligible and the growth of the spending. Like those things help, but that's not really fixing the problem. So like I said, we fixed the deficit by about 25% last year, but due to the stimulus and due to the fact that you can't just cut things forever because of the way the law is written, that it's not likely that that's not going to improve anymore. In fact, it's probably going to reverse course a little bit due to the stimulus, which it's hard to estimate exactly how much that's going to be. It could be that it doesn't really go back up too much, but it's likely that it could go back up a decent bit. And then on top of that, there's also the tariffs. Like I said, a huge portion of the increase or the improvement in the deficit comes from the tariff revenue. And there is the expectation that the Supreme Court is potentially going to strike against the specifically the Emergency Powers Act tariffs, which is a big portion of the tariffs being put on. However, it's not all of the tariff revenue that we collected last year is under that law. And the administration has also stated that they have backup laws that they would use to enforce tariffs on. So if the Supreme Court does rule against the IEEPA Emergency Act tariffs, there is still a good chance that they're going to be able to still be able to put a large amount of tariffs in place. And so, for example, like the amount of tariff revenue we collected last year was largely April onward, right? It wasn't the full year. It was April onward. So it was like 3/4 of the year approximately that we had been putting the tariffs on, and they kind of ramped up a little bit. So it was actually maybe more like even just 2/3. And so even if you just kept the current tariff laws in place, tariff revenue would probably increase this year by another quarter or a third, just because we would be doing a full year's worth of it. So I did some estimates using AI, using an LLM. I was kind of asking a bunch of questions about this and was trying to get it to make some estimates for me. And what it came up to was basically saying that if you did strike down the Emergency Powers Act tariffs, because by the way, it is largely I think the kind of weight of the opinion is that there's actually a better than likely chance that the Supreme Court will do that. Like I think the odds on Polymarket or Kalshi is like 2/3 or something percent chance that the Supreme Court rules against it. And I think there's a lot of good reasons of why you would believe so too. So I think is quite a good chance the Supreme Court does strike against it, just because they will want to preserve their own power to a certain extent. But we'll see. We'll see. It could totally be that they actually don't strike against it. But assuming they do strike against it, because that seems likely to be the case, and then assuming that the Trump administration does put forward these other alternative laws for putting tariffs on, and then also assuming that we have the full year, the AI told me that we would probably collect a similar amount of tariff revenue to the amount of tariff revenue that we collected last year, which was the, like I said, 8 or so months worth amount. So essentially that means to me that on the receipt side, I don't necessarily expect to see a huge deterioration in the deficit. It's just on the spending side we expect to see further deterioration. So yeah, I expect deterioration in the deficit this year, but not necessarily a dramatic amount of it. And then also one of the other comments here, like I said, like I'm trying to talk a whole lot about basically every little detail of what Jamie Dimon said here, because I think he kind of said a lot here in this one little paragraph. But he also talked about deregulation. Deregulation in general, not just for banks, as he said, but banks will be able to redeploy capital. So what is he talking about here? He's talking about changes to the supplementary leverage ratio, which is an extra risk management regulation that was put in place after the great financial crisis. Now, I know when a lot of people hear the word deregulation, especially in the context of like the great financial crisis, you probably have big flashing red lights in the back of your head that's like, oh, warning, warning, that means there's gonna be a problem. Now, I will say that deregulation gets a very bad bag because yes, financial crises can often happen sometimes after a bout of deregulation. But the point is, that doesn't mean deregulation itself is bad. It often means that there was a specific regulation that got deregulated that you might have wanted to keep, or maybe too many deregulations all at once. So what I would say though is that regulation itself can also be bad. They both can be bad if done poorly. That's the truth. And so after the great financial crisis, they put all sorts of new regulations in place that severely hampered commercial banks from being able to dramatically increase their loans going forward, because frankly, it was like PTSD due to the great financial crisis. And so with that in mind, sorry, hold on, looking for detail with that. With that in mind, I do think that it's not necessarily a bad thing to release some of those regulations, because we do want banks to be able to make loans, and the alternative can be worse depending on how you think of it. So like, for example, I'll just bring this up right here. Federal Reserve data showing loans and leases and bank credit for all commercial banks. And just, this is the year-over-year growth rate. So I'm just kind of showing you the rate of change of how that goes. And then, so here you can see we had kind of like 5 to 10%, sometimes even higher than 10% for periods in the 90s. And then we had the tech bust. And then going out of the tech bust, we had going into the housing bubble, and we had 5 to 10% for the first few years. And then when the housing bubble really started going off, you could see that we were well above 10% for several years, just consistently 11, 12, 10, 11, 12, 10. And then we had the big bust of the great financial crisis. So, you know, I would say like 5 to 10% is probably a pretty healthy level to kind of be at. And it's maybe like when you're accelerating beyond that. And obviously it depends on what's actually happening in terms of real growth in the economy. It's like loan growth is not bad per se. The question is how much economic growth are you getting relative to that loan growth? So the thing I want to especially point out though is the post GFC world. You can see the post GFC world. We were sitting here in less than 5%, 0 to 5%, and then we got above 5% for a few years, going in 2014, 2015, and in 2016. But then we came back down into kind of like the 5% range. So we actually had difficulty even getting back to the loan growth levels that we were at in the 90s. We didn't want to get necessarily back to where we were in the mid 2000s and whatnot, going into the great financial crisis, but we did sort of at least want to maybe get back to this like above 5% level. And that we had a lot of difficulty really getting to. We had a couple of years of it, not so good, and then COVID happened, and then we had kind of the spring back out of COVID, and then the few years since then. So this trend right here, where we're seeing loan growth starting to pick up again, that's, I think, to a certain extent, that's banks forward running these expectations, because the supplementary leverage ratio was an extra regulation put in place that was basically a dual regulation on top of already existing regulations. We had another thing called the risk-weighted asset levels, as well as CET capital ratios. They have multiple of these measures. The banks essentially have to make sure their risk levels are well tolerable for. But the point is, they can become too restrictive, and so over the next year, there's expected to be basically a significant releasing of bank capital, which is like their equity on their balance sheet, in terms of how that capital is not going to be as necessary for them to hold on to, for them to be considered less risky according to the regulators. And I can't remember the exact number off the top of my head, but I think, because I was asking AI about this several months ago, I think they said that it's approximately, I think it was 400 billion in bank equity that that they're going to release. And like, let me see if I can bank. I should have tried to find this as well beforehand, but let me see if I can quickly find the. This can be a total equity. Yeah, okay, total bank equity. So here, $2.5 to $2.6 trillion in total equity across the banks in the United States as it currently stands from the last quarter. So what we're saying is like a 400 billion, which would be what is that? 4 out of 26. What is that? 2 out of 13. And I'll just do the number itself. 4 divided by 26.5. That's about 15%. So that's going to be like a release of about 15% of the overall equity that the banks are holding. And then people, and you might say, well, isn't that what they need to protect themselves from loan losses? And I would say, yes, that is true. But the point is the banks are actually more capitalized now relative to their loans than they've been in a long time. So that's what I would say, is that it's probably unnecessarily held capital. It's basically their balance sheets are too bloated in terms of holding on to that capital. And what that means is that if that capital is released, that 400 billion is released, the bank balance sheets are levered. So 400 billion, if you lever that 10 to 1, then that's 4 trillion. If you lever that 20 to 1, that's 8 trillion. Now that I'm saying the numbers out loud, I think it might have been actually like 200 billion, because once I lever that up, that sounds too large relative to what I remember. But even so if it's 200 billion, that's 7 to 8% of their capital. And that means that you can lever that up again, 10 to 21. That basically means, like, you can just think it as that. If it's 7 to 8% of their capital, that basically means that they can increase their balance sheets by 7 to 8% immediately, just regulatorily, they can just increase it 7 to 8%, which means loans. That's a lot more loans being put out into the economy, which means more growth. So that's sort of what JP Morgan's referring to when he's talking about that. And I think it's a very, very good thing. That's actually, I think, one of the most understated and least appreciated parts of the changes in policy that happened with the new administration last year. So be very interesting to see how that works out. Then there's other things as well that are potentially opening up the balance sheets a bit for banks as well, and that has to do with the growth of the stablecoin market. But I still need to do a lot more research on that, so I don't even really want to necessarily get into that topic. But I do think that stablecoins themselves are potentially going to create an interesting potential for I lost it for the banking industry to potentially grow a little bit faster than they've been growing, as well as for deficits to potentially be improved as well. But that's, like I said, a whole separate topic. So yeah, that's my thoughts on the bank earnings. We talked there for a little bit, probably longer than I was intending to talk about with that particular one. But hey, what else is new? So also, though, with us still kind of on the topic of JP Morgan and Jamie Dimon, there has also been in the last week all of the news about Jerome Powell. There is an investigation investigation into Jerome Powell in regards to statements that he made to Congress about the renovations of their building, and potentially some sort of like criminal indictment is sort of on the way. Jerome Powell made a video and released it on the Federal Reserve website, which is kind of interesting. So Jerome Powell's largely tried to shy away from all the politics stuff for most of his career at the Fed, and even with Trump kind of getting on his tackles about interest rates and really kind of trying to push him, he's largely just tried to kind of like steer away from the conversation as much as possible. So it's kind of interesting that he actually went out and made a video and put it on the Federal Reserve website, basically say, hey, this is totally political. I think that this whole criminal indictment is largely just because they want me to lower interest rates. And the truth is that's basically the case. What doesn't matter what you think about the renovations. Maybe there's truth to that. Maybe there isn't. I don't really care. It's not really relevant to me. It's clear that it's all just a push to essentially get them to lower interest rates. And it's not even necessarily about Powell. What I will say is that it's actually, I would think, more about sending a signal to the FOMC at large post Powell, including to whoever replaces Powell, that, hey, if I could start an investigation towards Powell, I could also start an investigation towards any person on the Fed if I don't get what I like. So I do think this is definitely a huge push to essentially try to get that. But at the same time, I will say that, I'm not a fan of the administration pushing against the independence of the Fed, but I'm also not really a huge fan of the Fed either. So in a sense, this is sort of like the Wall Street Journal had an op-ed article. I can't remember the exact title of it. Oh yeah, here it is. Yeah, it's in Trump versus the Federal Reserve, may both sides lose. It's an article by Joe Sternberg on the Wall Street Journal, who I'm a decent fan of. I think he does pretty good writing and work there. But that's, in a sense, my opinion. It's like, you know what? I don't really like either one. So good luck to both of you. It's like I don't really agree with either case. I don't think you should be overly politicizing the change in interest rates, and I don't think the executive branch should necessarily have a whole lot of say in it. But at the same time, I don't think that the Federal Reserve has done a particularly good job of safeguarding the currency in the care of the American citizenry. 2% inflation is not stable monetary policy, in my opinion. I fully disagree with the perspective that you actually need inflation for a modern economy. I think that we've made our modern economy addicted to inflation. So I think that, changing that now immediately, right now, that would be probably very devastating to do. But going back, I mean, if I was in charge of the Federal Reserve from the moment of its founding to the present, I would never have had that kind of policy ever. That's just horrible, in my opinion. There are economic reasons why the classical Keynesian perspective is that you want to have moderate, low, but positive inflation. There are reasons for that, and it's because they're fearful of deflation. But in my opinion, fear of deflation does not mean that you just accept the negatives of inflation. That's just, in my opinion, bad policy. And then, like I said, that's just the base policy that's gone back 100 years, 110 years for the Federal Reserve's existence. But there is also the I would say dramatic mistakes in policy made in the wake of the great financial crisis as well, which is to say all of the quantitative easing, the buying of mortgages, and the mass buying of long-term government bonds, which has suppressed interest rates and also increased housing prices. And then the suppressed interest rates themselves have increased asset prices dramatically. So they were literally trying to stimulate inflation coming out of the great financial crisis. That's why they did it, is they do quantitative easing because it supports prices, but it didn't really support consumer prices in the short to medium term after the great financial crisis. It just pushed all of that price inflation into asset prices, which then exacerbated income and wealth inequality, which has led to mass uprisings of populism in our political system, which has then led to all of these fights now about the independence of the Fed. So in a sense, the Fed, I would say, is actually more at fault for the destruction of their own independence than I would blame Trump. Trump is the instrument by which it's happening, but he's the effect. He's not the cause. He's the effect. So like I said, not in favor of it. I don't want the executive branch to be trying to control monetary policy. I do think it would be better if you had essentially a technocratic rules-based system trying to control monetary policy. I do think that's generally good. I just think that the approach that the Federal Reserve themselves has used is not particularly good. So yeah, in Trump v. Fed may both sides lose. Now, of course, that's probably not really how it's going to happen. I believe Trump himself made comments that he didn't even know about the investigation. Whether that's true or not, he's obviously whether you believe any specific comment that he makes is hard to say or whatever. But also at the same time, it could very well could have just been some investigator. So who knows? The investigation may go nowhere, but it is nonetheless meant to put pressure essentially on that. So who knows? We'll see what happens with that. Whether Powell does in fact leave, because his term as the chair does end here in a handful of months, but he doesn't have to leave the board. That's the thing, is that he can stay on the board. And so in many ways, I do think this is just bad strategy on the administration's part, because if their goal is to get Powell to leave, they probably should have just left him alone. But like I said, I do think it's more about than just about Powell himself. It is also about trying to send a signal to the next person who's the chair, as well as just the other members of the FOMC. So here, looking at the 10-year government bond yield, you can see that not really going anywhere. And I was saying that, I think back here I was like, probably not likely that the 10-year is going to go down too much. Like a year ago, here we are. Not really going anywhere. I did thought shorter term rates would probably come down, and they have come down a bit, but not nearly as much as I had certainly hoped they would over that same year, which gets back to the yield curve, which is the difference between the two. You can pick your maturity of which version you want, but I specifically was talking a lot about the 10-year minus the 2-year, and the 10-year minus 2-year, like when I first started kind of talking about it, it was like here in this range, and then I continued to talk about it all throughout here in this range. And it has come up a little bit, but definitely not a ton. And like I said, that's relative to the 2-year though. You can change which ones you're using as your measure. If you use a 3-month, then it looks like it's maybe improved a little bit more so, which is technically a more comprehensive level of it, since 3-month is closer to immediate. But I still do think we're going to get a little bit of likely steepening in this. I had said that my base case was largely that we would at least get up to like a 75 basis point kind of level, and we're kind of hanging out around just under like 60 basis points. So we're getting there. We're sort of getting up to that base level, but looking back historically, really the likely level would actually be like 1% plus. So technically, even saying 75 basis points, I would say is a very cautious, conservative assumption in regards to steepening, but we'll see. I still expect that. And if they do manage to get people in the Fed who are going to cut the short-term rates even more, well, then it's more likely that we're even going to get that. And then also, I will say, kind of last detail, I think that it is highly related to politics, which, I don't like talking about politics that much on my show, but man, if it isn't true that this last year in the markets, that things happening in politics has been way more important for markets than they had been for the whole decade prior to that. There's definitely no doubt about it that politics has unfortunately been more important to think about than it had in previous periods. And maybe we can get back to a period where politics isn't that important to markets, but it's just true. The changes in policy can have dramatic impacts, so you do kind of have to think about them. But the discussion about who the new Fed chair was going to be, it had seemed for a handful of months there that Trump hasn't made his announcement about it, but it seemed like the favorite pick was largely going to be Kevin Hassett, which was seen by the market as essentially the most political of the kind of 4 or 5 top contenders that were out there. The one that was basically kind of bullhorning the administration's preferences as much as possible. He's the current head of the Council of Economic Advisors, I think it is. Like there's like 4 or 5 of these economic groups with like slightly different acronyms, so I sometimes have difficulty remembering which one's which. But yeah, the Council of Economic Advisors, I think, is what he's the current chair of. And then Trump recently said in an interview this week that he likes Hassett where he is. And so that kind of shifted a lot of the perceptions, especially in the betting odds about who the likely person is going to be. And it seems now that the current expected favorite is now Kevin Warsh, who is also very positive and accommodative, I would say, to the administration's beliefs and preferences. But he's definitely seen as a less political person than Kevin Hassett. He's seen as somebody who has a little bit more proper accolades in terms of actual like economic and monetary policy experience, and therefore is seen by the market as a even better, more likely person for the job. However, I will say, because of the big contentions with Trump and Powell, there has also been various people in Congress who are now making threats about whether they're going to confirm the next person that Trump desires. And I haven't looked far into the details of it, but I heard from someone who I believe knows what they're talking about, so I'll maybe look into the details of this. But they had said that there is a potential chance that if they don't confirm a new chair within a certain time frame, that there can be a sort of default option put in place based off of the current voting members of the FOMC. And I was led to believe that it would be Michelle Bowman, who is would likely be that person to sort of default into the chair in a period where the Senate appears unable to confirm a new chair. So they would basically kind of be like the temporary chair, so to speak. And Michelle Bowman is already on the FOMC, so already kind of has those accolades to a certain extent. And I believe she's somewhat dovish towards the administration, but still not dramatically so. And so that's one of those things where it's like a lot of these political actions against the Fed, the goal is, it should hopefully, the like long-term goal is they're trying to get interest rates down, but in many ways they're not really doing the things that strategically would be the best choices if that was their goal. So hopefully that all works out for the best, because I definitely agree that our financial situation, our fiscal situation, I've talked a lot about the deficit earlier, and I was talking a lot about Medicare and Medicaid and that part of the deficit, but the interest expense is a huge part of the deficit too, and it's one of those other categories that is largely non-negotiable unless you want to make big changes and upheavals in the way things do. And I'm that's, like I said, I have a whole list of things that I would do or would be willing to explore doing if I was the president or the economic emperor of the world, as I'd put it, because really you need to be more than just president to really fix the deficit. You sort of have to have like you have to be like dictator of the economy to be able to like make all the changes that, in my opinion, you sort of need to do. Or you need to have very broad-based support across all three branches of government. And that's sort of the issue, is that we don't have broad-based agreement across all the areas. But point is, interest expense is largely non-negotiable. What they're currently trying to do is they're trying to get these short-term rates down somewhat through this intimidative policy, so that they can then refinance as much of the government debt at short-term rates, which they think will then give them time to essentially squeeze the treasury market even further, as they have been doing, for the record, for the last year, through limited treasury issuance, which Janet Yellen had already been doing that policy to a certain extent, but Scott Bessent has basically continued that policy, which is to say that during the auctions where they issue new bonds, they have been issuing a large amount of short-term bonds, and the market has largely been gobbling up those short-term bonds, but then they've been very, very thinly issuing the long-term bonds. And that means that they're restricting the supply. And by restricting supply, you increase the price. And if you increase the price, you lower the yield. So that's what the approach they've been doing. And obviously it hasn't worked to actually lower the yield, but what it's done is it's suppressed the market's desire to push the yield up to any large, significant extent. And the point is, if they can get the Fed funds rate down to a much lower level, that means that they could issue a lot more debt at shorter term rates, and then they could restrict that supply even further, and thus potentially get the longer term rates down. That's the strategy. Like I said, there's a lot of huge caveats to that as to why that may not work. So it's, I don't, like I said, I don't necessarily agree with that strategy, but I understand it. I at least understand what the strategy is. And it could work. It could work. I'm not saying it's impossible that it works. It's just, there's definitely other players that have significant impact on that. And including, for example, like foreign holders of our treasuries, major foreign holders of our treasuries could start to sell significant portions of their holdings if they don't like what's going on with that. And that's where some of the big risks are. So that leads us actually sort of into one of the other topics I did kind of want to talk about, which is foreign liquidity. And that relates directly to one of the largest foreign creditors to the United States, that being Japan. So I talked a lot last year about the dollar as well, the foreign exchange value of the dollar index, the Dixie, as people often call it, shown here. And you can see that after we were kind of already up in a little bit of an uptrend here. And over the last 2 decades, we were in a uptrend as well. So put that in context because it's important to understand that. But we had a big run up, especially with the Ukraine war, beginning of the Ukraine war, which then corrected a bit, but left us at a higher level. And then we were having a run up towards the end of the election. And then after the election, going into the new year, it continued the run up. And then around the time that the administration actually took office, basically since then, it started to slide pretty significantly. And I saw plenty of headlines about this, and I think it's kind of a funny thing when I see headlines talking about the dollar exchange value, because it just goes to show that people talking about it don't seem to understand economics from a global level very well. Because the assumption is that you see, oh, dollars going down, that must be bad, right? We're Americans, we use dollars, we like dollars, we own dollars. Therefore, if it goes down, it's bad, right? And it's like, well, yes, but also no. It kind of depends. Like this is not the same as like the value of your portfolio going down in dollars, right? Like the value of your portfolio is priced in dollars. So when you see that value go down in dollars, it means that the value that you could get in exchange for it to other people has gone down. But what this reflects is the foreign exchange value. This isn't purchasing power, right? Like purchasing power, yes, the dollar is going down all the time, but all currencies are going down in purchasing power all the time because of the inflationary system in which we currently live. And so the point is the dollar index reflects the differences between the currencies themselves. And that means it does reflect differences in inflation. It does reflect differences in economic growth rates. It also reflects differences in interest rates. And that last part, I would say, is very key, because if you expect interest rates to be coming down, and by the way, it's actually tends to be shorter term interest rates, like 1 to 2 year interest rates are the thing that influences the foreign exchange values more than like the longer term rates. Longer term rates affect asset values more, but shorter term rates affect currencies more. And the reason why is because people will essentially, large global investors will borrow in one currency in one market, and then they will go and invest in another currency in another market. That's a very common strategy in Forex that people do. And so, like I said, we're going to be talking about Japan. Japan is one of the very, very popular places to do this, because Japan has had extraordinarily low inflation, if not deflation. But that means that they have low interest rates, and so people will go and borrow in yen in Japan, and then they will exchange that into dollars to then go and invest in the dollar markets, whether that's in dollar bonds and treasuries just to capture on the interest rate differential, or potentially even into the broader, larger capital markets and the equity markets themselves as well, to capture on just kind of larger returns as well. So it's important to understand that, because like I said, like, yes, as an American, you don't want the dollar to go down, sort of, because, you know, that is your dollar. But the point is like I said, this is a relative measure. This is a relative to other currencies. So the question you have to ask is, as an American, do you exchange your currency into foreign currencies a whole lot? I don't. I haven't exchanged my currency into a foreign currency as a consumer really ever. Like really ever. Like I've gone to Mexico a couple times in my life, and I got some pesos then. But we're talking about, like, out of all the money I've earned in my entire life, it is basically none of it that I've exchanged into foreign currencies. I've exchanged a little bit of my foreign currency to invest in a foreign stock. I've done that a little bit before as well, but that's, like I said, a capital market decision rather than a consumer decision. We're kind of looking at this more from the consumer perspective. And so what I'd say is, like, unless you're a wealthy person that takes trips overseas all the time, which maybe you are, good for you if you are. My point isn't that it doesn't affect nobody in America. Like I said, my point is that it does not affect really the majority of Americans and the majority of consumer dollars. It does have an effect. People will still care. Like I said, you don't want the dollar to crash and plummet through the floor, but the dollar exchange value correcting, I would say is not necessarily a bad thing. In fact, I would argue it's sort of the opposite, because again, you have to think about that global understanding of people borrowing in one rate in order to invest in another rate. People do this in all currencies all over the place. And so, and then also because of the fact that the dollar is the reserve currency of the world, people also issue loans in dollars, even when that's not their currency. Like people in, say, Switzerland may want to loan money to, say, people in Bulgaria, but because Bulgarian currency isn't as stable, I don't know what the Bulgarian currency is, so don't take this personally if you're Bulgarian. I'm just picking countries here. Maybe the Bulgarian currency isn't super stable relative to what the Swiss believe. And so maybe in their agreement, they said, okay, we will loan you money, but we're going to loan you money in dollars, and you therefore have to pay us back in dollars. And this happens quite a lot over the whole global economy. In fact, that's really, I would say, the most important aspect of what a reserve currency is. People think about reserve currencies in terms of like how everything's priced, and they also think of it as, okay, everyone, central banks and foreign governments are holding a bunch of dollars as and dollar assets like treasuries and dollar assets like the equity markets, and because they like the stability of that. But that's actually almost secondary, I would say, to the financing aspect of a reserve currency, which is to say that one country that has one currency, currency A, is going to loan money to person B in currency B, but they're not even going to use currency A or currency B. They're actually going to use currency C, which is the reserve currency, which is mostly the dollars. And if you look at this type of transaction where people are exchanging in an alternative currency, dollar is by far and away the vast majority of it. I can't remember the number off the top of my head, but I think like last time I checked, it's like 80% of that type of lending, which amounts to many trillions. It's like I can't remember what that number is either, but it's like at least a solid handful of trillions of dollars that is basically currently loaned out in dollars by people who do not use dollars themselves to people who do not use dollars themselves. And the effect of this is that means that for those people to pay back their loans, they have to eventually exchange their own currency where they were doing business in back into dollars to then pay that loan off. And how that works is what that does, that gives a perpetual bid to the dollar, which is why, like I was pointing out before, the kind of almost 20-year upward trend in the dollar bull market is because ever since the great financial crisis, there has been actually an acceleration of that kind of behavior of people loaning to people outside of that. So as people have needed to pay back those loans, it's created a kind of perpetual bid to the dollar, causing it to rise and rise and rise. And the thing about that is that if the dollar itself is rising relative to all other currencies, because that's what this is a weighted basis of other currencies. It's heavily weighted towards the euro, for the record. The dollar index isn't exactly a perfect measure of this, but it's the one we have great market pricing for. So it's the one I'm kind of talking about. But the point is, like, as the dollar becomes more expensive, that actually makes it harder for those people to pay back their loans, because that means that they then have to exchange an even greater amount of their domestic currency in order to acquire those dollars to pay back those loans. And this doesn't have a direct impact on the US economy per se, but we're talking about the global economy here. So what that does is that creates stress in the global economy as dollars become more and more expensive, because it makes it harder and harder for people outside of the dollar system to pay back their foreign loans. And so that creates economic stress in emerging markets especially, but just foreign markets broadly, which then causes a drag on the global economy. And if there's a drag on the global economy, it absolutely can come back home to roost in the US economy. So that's where I would say is, like, I actually look at the dollar going down, as long as it's not like just falling through the floor, as long as it's kind of staying like here. This is, 75 years of looking at the dollar currency. You can see it's like it's moved up and down all over the place. But as long as it kind of stays within a certain range here, then as long as going down within that range, I would consider actually a good thing. So then, like I said, that was a long explanation to kind of get to like the real topic, which is Japan. Real topic is actually Japan. So let's We have the dollar index up here. Let me also put the dollar relative to the yen up here. And then let's also put another one. Let's put the euro relative to the yen. And, you know, that's probably fine. We don't really need to have a million of them, but I want to have at least a couple of them so that I can kind of show something about this. So here you can see that throughout 2025, the dollar was coming down pretty decently, and then it kind of stopped relatively around here. Let me put the actual value here. It stopped around a 100 level for the Dixie level. It's kind of been floating in this range for some time here. And then you can see that kind of as at the same time here, we initially had a little bit of a downward movement in the dollar. The blue line is the dollar relative to the yen. So the dollar was coming down, and then until we reached April, which is around the time that we had the tariffs put on, right? The Liberation Day event, and then also the euro is the green one. That one was a little bit more flat. So the dollar was coming down relative to the yen, but the yen or the euro was relatively flat with the yen. So you can see that it wasn't really about the yen. It was really about the dollar during this first part here, because this is flat and this is coming down and this is coming down. It means that this downward motion between the two of them has more to do with the dollar than it has to do with the yen. Because that's the thing, is whenever you look at these currency pairs, you have to say, okay, well, which part is driving it? Is it because one thing's going up, or is it because another thing's going down, right? And you have to kind of think of both sides at the same time and hold both thoughts in your head at the same time, which is why foreign currencies are so difficult, by the way. It's because you have to kind of be in two minds simultaneously to really understand this. And that's why I put both the dollar and the euro up here, is because it helps us to kind of separate what's going on here. But then once we reach April, you'll see that the dynamic kind of changes. The dynamic changes. The dollar continues to go down for a little while here, but the dollar, the blue line, starts to go up relative to the yen. So even though the dollar itself is going down, the dollar is going up relative to the yen. Now, what would cause that? If the dollar is going down relative to other currencies as a whole, then that means that people are selling their dollars in order to get those currencies, or they're selling their dollars in order to buy dollar assets. By the way, if you take dollars and you purchase the S&P 500, that is downward pressure on the dollar, because you're selling dollars. You know, you have to think about it that way. It's like all currency, all transactions, you're long something and you're short something else. That is what all transactions are, is you are effectively longing something and shorting something else. So if you go long the S&P, you have effectively shorted dollars, because that's just the nature of how currencies work. So the fact that here you can see at this moment when Liberation Day happened, when the tariffs were put on, we suddenly had a big change in the dynamic where the euro started to go up relative to the yen, and then the dollar started to go up relative to the yen. And then even though the dollar itself is going down, that means that the yen was going down. That means we shifted from a period where the downward motion was because the dollar was going down. And then, yes, the dollar continued to go down, but in yen terms, it started to go up. And then because the euro is also going up relative to the yen, that means we know that it's because the yen itself was going down. So that's the thing I'm specifically trying to point out here. That's why we're talking about Japan, is that the yen currency value has been plummeting for basically the whole second half of last year, but especially a lot going on here. So let's take the dollar off. Well, put that over here. Get rid of that. And we'll change this to a line so it's a little bit easier to look at, because I like looking at certain things in bars, but other things not necessarily, because it can kind of complicate it. But then let's also throw the treasury, the Japanese treasury, onto a scale as well. Wish it was a different color though. Cool. So then also you can see that the 10-year yield in the yen. Now I know I said that the currencies are more affected by short-term rates in general, But I'm going to show the long-term rate because that's where a larger amount of the asset is. So the fact that the yields going up means that people are selling the yen treasuries. The yen treasuries are being sold, and then the currency itself is also being sold. Currency, and which means that there's been a large step up in terms of this basis where people are borrowing in yen. If yen is becoming cheaper, then it makes it even more incentivized for people to borrow in it. And you can see that especially since May, this has really started to correlate. I mean, it was already correlated. You can see there's pretty good correlation in here, but they're really starting to accelerate upward together. And what this is, the reason why I'm talking about this is because this is actually a huge source of liquidity. I know that in like October, November, I was talking a lot about the concerns in the short-term liquidity markets in the United States relative to the SOFR markets and the repo markets. And that was a big deal. And we did have a little bit of a brief correction there. In fact, oh, that's what I want to do. Actually, let's pull the S&P 500 up. That's actually what we want to do. Put this back over here. So many scales, I know. But it's like these things are somewhat complicated to understand because it's like really, really a lot of things going on simultaneously, and you sort of have to understand all of the things happening simultaneously to actually get the story. So yeah, we'll put the S&P 500 actually in bars against the background there so that we can kind of look at that because it can kind of explain certain things about how this works. So basically, all three of these lines, the lines, not the bars, when they're going up together, you can think of that as liquidity increasing. And then when they go down together, that means liquidity is decreasing. And you can see that oftentimes there are little hiccups in the S&P 500 when that happens. And then you can see like also like initially when we had our little correction here, the first part of it wasn't Liberation Day. Liberation Day was kind of the second half of it. Like the market was kind of already correcting on the expectations of tariffs. So they didn't really correlate too well in that point there. But then once Liberation Day happened, you can see that, yeah, there was a big downward movement with all three together and that pushed that together. But then since then, you can see they've been pushing upward together. And like here was the period where I was kind of talking about liquidity, and we did in fact have a little bit of a correction there, but that had to do a lot to do with the repo markets. And we switched to the day candles. You can see that there was still largely an upward movement in the yen liquidity being supplied to the foreign markets, because that's what is happening. It's like if yen is being devalued, which is what's happening, more yen is being created relative to the global markets, then that means that yen becomes available for people to loan against, which means that people can loan against it, which means that they then take that capital back to, for example, often the US markets. And so that's how it becomes a source of liquidity for global markets. And so you might say, okay, interesting, Midas, it's very interesting stuff. Why are you talking about it? Reason why I'm talking about it is because it's when you have an acceleration of it like we've had here in the last few months, that is a positive for global liquidity, but it can become a worrying sign because, like I said before, you do sort of want your currency to go down in terms of how it can help things for your economy. As I was saying that for the dollar, it can be good, and that's true for the yen as well. So from the Japanese perspective, if you put yourself in the shoes of the Japanese consumer, it's sort of a good thing for their yen to come down. It's supporting their economy. However, you don't want it to fall through the floor. Like I said about the dollar, it's the same thing. Like you still don't necessarily want it to go forever through the floor. And because of the fact that yields have been rising, like I said, like we do have yields coming up do eventually start to push into a positive for the currency itself. So and like I said, I'm looking at the long term, which technically it should be the short term, but the long term is relative to the assets, but they're still related. The short-term rates have been moving up as well, and the short-term rates have been moving up because the Japanese economy has been getting stronger and inflation has been increasing for them as well. And so with all those things together, that means that eventually the authorities at the Japanese central bank or treasury or somewhere in the executive, at some point or another, they're probably going to take some dramatic actions to try to support their currency, which is going to cause this party to come to an end. So the reason why I'm bringing all this up is that I think that this is a potential big headwind that exists over the next few months. And headwinds maybe not even really the right word. I would say it's a potential worrying sign. It's a potential flashpoint. I would say pay attention to news articles related to Japan. That's what I'm doing. Like literally every market day, I search for news about Japan. And specifically, I'm looking to see if somebody at their central bank or somebody in their executive starts to make actions to try to support their currency in some way or shape or form. Maybe they'll put on some sort of capital controls about like how money can move in and out of the country. Maybe they will jack up interest rates even more. Maybe they will do something to buy back currency to support the value of it. There's a lot of things they could do, but the point is if there's an intervention in here, and because of the way it's been accelerating upward, that could cause a big hiccup in the global supply of liquidity towards the US markets. I was concerned back in November and December about the short-term US liquidity dynamics, and those have started to improve. Like they're not amazing yet. They're not really in super great territory, but they have largely improved, and that's good. And then like I was talking about with the JP Morgan stuff is that there is a lot of stimulus expected to come through over the next year as well. So there's a lot of good things on the US front, but this is a bit of a worrying sign because essentially the capital markets could get choked off of this global supply of liquidity if Japan decides that they need to support their currency at some point. And I do think that eventually that would happen. So that's why I'm talking about this. I think it's worth pointing out that you might want to pay attention to that, because if you see news related to Japanese attempting to make interventions in their currency or foreign policy markets or monetary policy markets in some point, then that would be a warning sign that we could get a little bit of a correction at some point. Maybe not a huge correction. It could just be something as similar as what we had in November or in July of 2024 or April of 2024. Like I said, those are kind of similar points, but it could also exacerbate an already existing correction, which is what happened in April of last year. So just like I said, long, semi-complicated topic. Hopefully I explained it in a somewhat understandable way. Somewhat related, but also somewhat unrelated. But I kind of want to also talk about it as a somewhat flashpoint, and it's kind of relevant to FG as well, is that there's the MOVE index, which is sort of the equivalent to the VIX for the bond market. They're a little bit different, but they're very similar as well. So, but it's an expected volatility measure. So if I put the VIX up against it, for example, you can see that not only are they similar, but they're also pretty correlated a decent amount of time. Not always perfectly correlated. So you can see, like, for example, here, since 2022, the MOVE has been much higher than the VIX, and that's partially because of the uncertainty around how high interest rates were going to go or when they were going to come down or not. And then as we've kind of reached the levels where people were like, okay, well, interest rates probably aren't really going to go up too much higher, it started to somewhat moderate. And then I'll point out that also since April, we had a big spike in both the VIX and the MOVE index in April. We've since seen a pretty steady downward slide in the MOVE index, which is kind of interesting. And that's portends very well. Like I said this is kind of relevant to FG, and it is relevant to FG because they had relatively poor numbers during the second quarter of 2025. And if you look closely at their commentary, they specifically called out bond volatility. They specifically called out bond volatility as basically causing some disruptions in their ability to price their annuities in ways that would protect them in a risk-adjusted manner, which caused them to pull back significantly in the annuities they issued, which was one of the major reasons why they had a weak second quarter. So I wanted to point that out because, one, you'll notice that we've been sliding over the last handful of months, which would portend, I would say, pretty good for FG's performance in the next quarter or two. Or what I should say is annuities performance in the next quarter or two. This is good for annuities broadly. It doesn't necessarily say that FG is going to do well relative to all the other annuity companies. That's a competitive thing, a whole separate thing. But this is good for annuities broadly. So that's one thing I would say is that would portend well for, Q1 or Q4 and Q1 earnings for annuity companies. Is the fact that the MOVE index has been low means that they can generally price things more advantageously for themselves, essentially. But at the same time, because it's like the VIX, it's an expected measure. That means people are expecting low volatility in the bond market. And what that opens up the door to is that the fact that the market could be pricing things wrong. So this could also create a little bit of a flashpoint And that flashpoint could coincide with the Japanese liquidity conversation I was talking about, because that relates to treasuries. I was focusing again against the S&P 500, but you could just as easily point out how it affects the 10-year treasury yields, because like I said, Japan is the single largest foreign creditor to the United States. I think Japan owns like $2.5 trillion of US debt or something like that. But yeah, they're the single largest holders of foreign holders of US Treasury debt. So the point is that if a bond market volatility spikes up, that would cause them to sell treasuries, which would cause 10-year rates to go up, which would cause asset markets to go down. So you can see how all those things relate together. So somewhat complicated topic, like I said, all this foreign exchange, interest rates, volatility stuff. Like it's all very, very complicated stuff. I know. Hopefully I was able to explain it relatively well, even though we had like 4 different scales there all at once. But yeah, wanted to talk about the topic because who knows, maybe nothing comes of it. But if we get a big hiccup right after the Japan intercedes in something, well, I will be here to say I told you so. that's all I'll say. So that's pretty much everything that I had specifically to talk about. No one really showed up in the chat today. I've seen a few people come in and out of the viewership today, so hopefully the lurkers at least enjoyed the show. But yeah, I have started doing a lot more screening over the last week or two. I know I've been very, very lax on my my valuation work over the last year. I know a lot of people are probably like, oh man, dude, this guy doesn't do a whole lot of valuations these days, does he? You know, I've kind of felt that way. I was focusing a whole lot on macro last year, and I continue to focus a whole lot on macro. And I was also working on changing my templates around, as well as my dashboard around. But you know, that dashboard has been coming along. I've been adding companies to it. I added some more companies in the last couple weeks, and then in our last show we did talk a bit about some of the newer additions that I said I was going to be doing more research into, including BP. I talked a bit about Adobe, and I talked a bit about Uber. I've since I think even adjusted the assumptions around each of them. I've adjusted the assumptions around a lot of these, but I've added even more companies as well. I do want to take a very close look at Uber. I do think Uber is quite interesting. I know Jonathan commented a few more things in the Discord about my comments there, and I know I kind of like looked at this and showed some of the details around it, but I'm not necessarily sure I even really emphasized just how conservative you could argue a lot of the assumptions I made here was. I do think I was pretty conservative on their potential revenue growth rates. I was maybe less conservative on their potential. Oh, I'm looking at Adobe here. My bad. Uber. I didn't remember to switch to the right tab. I'll say that doesn't look right, but the Uber growth rates, I have very strong growth for like the first few years, but then I have that growth rate really fall off relatively quickly, and that comes around to my own uncertainty. I haven't really looked deeply at the numbers and their filings and the KPIs. I was just kind of plugging in some numbers and looking at estimates and things like that. But if you take that into account, if you think that, you know, they could really get closer to like say a 10% growth rate for 10 years, which I totally think is possible depending on what you assume, then this could be a very, very understated valuation. I have them close to fair value here with decent expected returns nonetheless. But the point is you could potentially see some significant upside. And in terms of margin, I do have them increasing from their current margin base up from like 9% up to 12% or so, with like an average of like 10 to 11%. That's for an operating margin. And that's in keeping with their increasing of their operating margin over time. Like they've been steadily increasing it out of unprofitability into profitability. And so the question is really more about what is a sustainable long-term profitability at scale for them. And you could argue they're not at scale yet. So the point is I was willing to give them a little bit more in terms of their profit margin. And so in one sense, that's sort of bullish because I'm pushing the profit margin up. But on the other hand, I didn't really do deep fundamental analysis to arrive at that conclusion. So who's to say it's 12%? Maybe it's 15%. Maybe it's 20%. I don't know. You know, it's like, who knows? Who knows? This could be a massive overstatement, but it could also be a massive understatement. If their steady state profitability is 15% operating margins, and they actually could achieve like a 10% revenue CAGR, then me calling them fair value would be a massive, massive understatement. You know, like that would just be a massive underestimation here. So like I said, I actually do plan to do a much closer analysis of Uber potentially. I haven't really done a super full valuation video in some time, but maybe we'll make an Uber one. I don't know. But I am also still quite interested in Adobe. And for the record, I have not bought either one for my personal portfolio. I have taken nibbles at both of them for other portfolios that I manage, but not for my own personal money. So in a sense, I am long both of them, but in terms of the performance that I show you guys, I am not. So so they're not in there. They're not in the returns I'm showing yet, but maybe they will eventually. But like I said, I maybe want to do more closer analysis for both of them because I do think there's a very good strong bull cases for both of them. But I need a lot more closer analysis. And Adobe's such a tricky one because I have looked a little bit closer at a lot of their filings, and they really just don't give you much of anything useful in terms of KPIs. I found, which was kind of frustrating. I was like, wow, okay, you guys just don't give anything at all of like serious use. So kind of lame, kind of a little disappointing that fact makes it a little bit harder to make a good model for them, which I would like to make. But yeah, no, I'll probably, like I said, I'll still probably try. But the point is, I'm having difficulty finding the kind of information that I like to have in order to build good models. I can't really seem to find that information for Adobe, and I haven't really looked at Uber for that. But I have a feeling that that won't be as big of an issue for them. Like I said, I also had pointed out BP because I was looking for potentially an oil play. I do think that oil prices have looked a little bit low for the long-term potentials of them. There's reasons why they are that way. And also, since I talked about that, it's worth noting, technically oil prices have gone up since we last talked about it. So technically I was already sort of a little bit right, but we're talking only like a couple percentage points here, nothing major. But the point is nonetheless, oil could be interesting. Though it is worth noting that what with all the happenings in Venezuela, that's a little bit more of a complicated question, because if more production comes out of Venezuela than we've had in the last few years onto global market, then that would actually suppress oil prices. So it's harder to say. You might have to have a good analysis of the oil markets as well, not just of BP specifically. So we'll see on that front. So other ones I've looked at this week, I've looked at a couple other ones that are maybe kind of interesting that I haven't, like I said, I haven't done deep analysis on, but I'm potentially interested in. T Rowe price looks potentially kind of interesting. I'm showing a little bit of upside here, but I think I used reasonably conservative assumptions on that as well. Pretty much most of these, whenever I put something in here, it's usually, unless I've done like deep analysis on it, which by the way, I haven't really talked about it a lot, but that's kind of what a lot of these checkboxes are right here. That's what these are, is me kind of saying whether or not I think analysis I've done on these companies in certain categories is like supportive to their value. And that my targeting system, my allocation targeting system, is largely based around that. Like this has a huge impact on that. So that's what these are. I've never really discussed that much, but essentially, if you're looking at this, the more checkboxes you see for a company, the more confident I am in their value. That's basically how you can look at this. That's how you can read this. It's like sort of a measure of my confidence, and it directly impacts the targeting size. So that's sort of what's going on here. But the point is, you'll notice towards the bottom of the list, because I am actually this list is ordered based off of target size. So it specifically shows the ones with the highest target up. And it's not just the checkboxes that influence that, it's also the expected returns, and it's also the market cap as well that affects that as well. Market cap sort of being my proxy for liquidity. But yeah, so down here, down at the bottom of the list, we don't have a whole lot of checkboxes. T Rowe has no checkboxes. But that doesn't mean that it doesn't deserve checkboxes. It just means I haven't done the research to be able to confidently give it any checkboxes. But yeah, so kind of interesting. T Rowe, the asset manager. This you can make assumptions about that. I think the assumptions I made in the valuation were pretty conservative, and I found it to at least be sort of positive value, which means if you give it a little bit less conservative assumptions, then maybe it's even better, right? So so yeah, it could be kind of interesting, but like I said, I haven't done the close analysis on that. Also, Genpact. I've never really looked at this company before, but like I said, I started doing some screening here in the last few weeks, and that one kind of came up, and I thought was kind of interesting. They do a lot of technology services, including various labor supportive services, including also outsourcing services. And I thought that like I said, I used pretty conservative assumptions here, but I also thought in the back of my mind that I could make a pretty good case thematically as to why that company could do well, especially given the changes in immigration policy from last year. So like I said, I kind of want to do a lot more fundamental research in that, but I kind of want to at least call that out. Like I said, I'm just showing fair value here, but I think I used pretty conservative assumptions. So, it depends on what you put in there. And then, that is what it is. And I looked at a few other companies, but I didn't necessarily put them in this list unless they were at least kind of showing moderate value, unless they were a company that I was kind of already interested in for some reason. So that's why you'll see plenty of companies that don't show good value in the list, but that's because I put them in because I wanted to at least keep an eye on them, or because I found them interesting for some other reason other than just value. So there's that. And then Regeneron, one of our longtime viewers, and also our admin in the Discord, has been talking about Regen for quite some time, and I never really did deep analysis on it, and found better value from it a few months ago, and it's already kind of moved up to sort of fair value a little bit. But the point is I haven't looked closely at their portfolio of drugs at all, but it could be kind of interesting there to potentially look at as well. What I am planning to do also here in the next week or two is definitely take another close look at my gold miners, because they continue to largely rocket upward. And the way I put my assumptions into the gold miners, it's a little bit trickier than other companies to adjust the value for. Like I really do have to sort of adjust the actual revenue model as well as the value on a sort of a going basis, because the gold price is just relevant to it. So it all depends on what you assume about the gold price. And so you kind of have to constantly shift things around based off of that. But yeah, so that's what I'm doing. That's what's kind of been happening here in the watch list. And then on the subject of the screening I was doing, I mean, I have a whole list. I have a whole list of companies that I want to look at. Like I did some screening. My screening ended up with this 167 companies here that could potentially be sort of interesting. And then I've sort of already went through this list and narrowed it down to like a top, like I think it was like 35 or so that I liked in particular. And so I've started going through those. And like, for example, that was where T-Row and Genpact came from. They both were in that grouping. So I have a whole list of companies that, like, as soon as I get off the stream, I'm probably going to spend the rest of today looking at a few of those companies. But I will say, if you've got other companies that you'd like me to take a look at, you think are potentially interesting value, either because they have good growth prospects and good or in a good theme or in a good industry for the long term, or even if you just think it's like a super interesting deep value, throw it my way and maybe we'll take a look, because I'm definitely more amenable now to looking at some kind of just random higher risk potentially, but also potentially high value prospect companies. Like I'm willing to look a little bit more outside the box right now than really I was for much of the last year. I know much of the last year I just kind of focused on my core favorites really, and just was kind of like closely watching my core favorites and then doing a lot of macro research. But I'm willing to kind of like look a little bit outside the box currently, a lot more than I was for the last year. So feel free to throw things my way. So with that, I know I should have said this earlier at the start of the stream, I really got to get better at all these things, but please like the stream if you've somehow made it all the way this far, and please subscribe to the channel if you haven't already. Please join the Discord, free link in the description below. Also the pinned comment in the chat. Join the Discord, become part of our community where we chat about companies all the time. We'll go through all sorts of discussions of what's happening in the markets, share memes with each other, share research on different industries and companies. But yeah, come be part of our discussions there. You do have to be manually added into the group after you join the Discord, so you won't really be able to see anything immediately. So just be patient. It sometimes takes a day or two for somebody to get around to adding you in. Or you can attempt to message one of the mods that it'll show you if you want to try to expedite that process. But nonetheless, thank you to anybody who watched. I will catch you all in a couple weeks. All right.